Let's focus on investment strategy now. Paolo, as far as equities are concerned, with all the ups and downs, are we buying the dips, selling the rallies?
Yeah, we're not buying the dips just yet. And look, we think that we'll see this lower markets with volatility for some time still. Our big concern is that we know about the troubles globally. Obviously, they're well documented. Maybe this time around, the whole pullback is going to draw out a little bit, partly because it's not one of those crashes that came around that caught us all by surprise. From the financial crisis onwards, governments have been involved. Everyone's been well aware of the risks. So every time there's an issue that comes forward, someone puts a plaster on. So it never really cracks. So we put a little plaster, and then 2 weeks later, there's some European issue, and then we put some European bond, and then it's an American, and we put some extra cash in the market. So we move down, and we move up with the plaster, and we move down again. It's not happening in a big move. It's actually being drawn out. So we think that if you look at markets and then the way they move, traditionally you'll get a very fast pullback, and then gradually it starts to climb up and the confidence builds up and so forth. Because there's so much awareness and coordinated effort from global banks around the world, we see it just slowly pulling a bit lower in these whiplashes. And they're quite big sometimes. I mean, markets can move 4-5% in a day. But that really reflects the uncertainty in the market in our view. And the troubles that we see globally still have some time to play themselves out. But they're playing out over a long time because there's a lot of awareness around it and a lot of appetite by governments around the world to put these plasters on. And our next phase we think that the globe will still be challenged with is a political challenge where, sure, they're putting austerity measures in place. It might be Greece, it might be Italy, but this is now a great time for opposition parties to come forward and say, no, that's the wrong thing to be doing. And so the political debate is probably still going to occur, which might bring some more uncomfort, not only on the countries that are feeling the pain, but even in Germany, where you're seeing some political pressure saying, well, why are we doing this? Why are we supporting you? And this is going to bring a different dynamic maybe, which might stretch it out a little longer. So we're not buying yet. We're waiting a little bit longer.
Sorry, Jason, it's almost a roller coaster ride in slow motion. I mean, I looked at, we're at 30,500 on the All Show, and I look at that 10% off the high. I look what's happening out there, and I think this is madness. And then we get days where, 3% this way, 5% that way, US data getting downgraded. From a trader perspective, volatility, wonderful stuff. From an investor perspective, this is scary times. You can't turn on, you can turn on any news channel, and there's just flows of bad news, markets going crazy. Your broad strategy, or are you just taking this and trading it more than anything?
Yeah, look, the market's very tricky at the moment. I mean, we just don't know where the bottom is. We don't know where the top is. There's so much uncertainty. You've got sovereign debt. You've got, as you said, America getting downgraded. We're just trading volatility at the moment. We're not even trading shares or stock specific. You're trading volatility. You're trading the swings. And the swings are going to get bigger, I think. I think the volatility is going to increase, the swings are going to increase. And it's a nice opportunity if you're a trader. This is a trader's market. You can make a lot of money if you get it right. If you get it wrong, you've got to cut your position quickly and early. So you've got to minimize your losses. But listen, it's great at the moment. We're enjoying it. But
we as a trader.
It is sleepless nights. Because you just don't know, it's going to go. We don't know if it's going to be up 5% tomorrow, or down 5% tomorrow, and that's literally, you saw it with Sasol, for example. It was trading at 339 a week ago. It went down to 310 yesterday. It closed at 328, I think.
328 and a half.
328 and a bit, and that is the volatility that we're dealing with. It's not about valuations at the moment. It's about fear. It's about how much you can lose. We're only down 10%. Can we come down another 20? Sure we can. Literally we can do that.
But the real question is, what do we do though? Do we go defensive? Do we go ultra defensive? Do we take the contrarian view and start buying up the construction stocks? What do we do?
I think you're going to look for dividend yield in this market if you're a long-term investor. You've got to look, once again, strong balance sheet, good dividend yield. Try not to pick something that's too expensive in the market. Maybe your telecom stocks. Defensive. Your pharmaceutical stocks are defensive. There is place, you can't hide. That's what I'm trying to say. Everything comes down when markets crash and correct. Very few stocks go up. So it's just, once again, how much are you prepared to lose? right now.
Paolo, you said you're not buying just yet. When it comes time to buy, and I'm not going to ask you to put your head in a block and give me a day and a time and an hour. We'll do that off air. Is it going to be the defensive stocks? Is it going to be the Anglos and Billetons, that PEs that everyone's saying is too cheap to imagine?
Yeah, so some of those are starting to look attractive. What we've done is going back, raise some cash and restructure the portfolios into more defensive positions, pretty much as what was said a moment ago. So we're looking for South African defensive stocks. That's where we've kind of positioned, and some of those are still probably looking quite attractive. You could actually use this opportunity to pick up. So you get a bad day, market's down 3-4%, get the bad day, pick some of those up, because you know you're going to hold them for the 5 or 10 years. Then this is probably offering those opportunities. And typically, like a Vodacom, for example, which is one that we favour, 5.5% dividend yield, good cash flows. This is a great story in our mind. So if you can find those on the weekdays to nibble and add to the portfolios, and certainly we wouldn't be against those. An investor who wants to accumulate these kind of positions. But as a strategy of we're going into the market now, no. I don't know when, of course, because as I say, we still think there's some of this has to unravel itself further.
Paolo mentioned Vodacom. Jason, what is your stock pick for the moment?
My stock pick is Blue Label Telecoms. I found it a very exciting story locally and internationally, particularly on the local front, the prepaid electricity, very exciting. On the international front, they've got a presence in India. They've got a presence in Mexico. They're paying a 14 cents dividend on Friday. So its dividend yield is about 3%. So, it's down 30% this year. Have a look at the other telecom stocks are up significantly. I think it's a value play. I think it's a long-term play. I think you've got to own it. You've got to have it. And that's my stock pick.
Blue Label Telecoms for Jason. What about you, Paolo?
Yeah, our hot stock is life care. I think what attracts us, this is typically now your South African stock. It doesn't really play anywhere else, but in South Africa at the moment, it's quite a defensive industry, obviously. It's got a very strong cash flow. If you look at their debt, it's about 1.7 billion. They're generating about $1 billion a year per annum in cash flow. So within 2 years, they'll have no debt. So that's a really strong position to be in. They're looking internationally. They're looking at India and so forth, Turkey, Nigeria. So they are looking to make an acquisition. So for they may not, of course, but they'll just put them in a very strong cash position. So we like the cash story behind it, the defensive nature. They've got occupancies, if you call it that, close on 70%, which is better than most of the hotel groups have got at the moment. And you don't get a choice, of course. You go there because you have to. And that can kind of escape this kind of volatility that we're seeing. That's typically a nice stock in this environment. And that's why it's our hot stock.
Paolo's defensive. Simon, how do you feel about Life Care and Jason's Blue Label?
Life Care, absolutely. Nice and defensive. And I prefer it to the other guys in the space, Netcare and the like, because they've got some serious debt issues with expansions, respectively, into Scandinavia and the UK. And I know it's all ring-fenced, but we want strong balance sheets, and that's what Life Care's got for us. So great stock. And Blue Label is one of those companies everyone's recently saying to you, you've got to buy it below R5. Absolutely. I like their model. They've got the point of sales out there. They can now just start plugging in new products to sell through there, and pretty much those new products go to the bottom line. So I think both of them, great stocks.